Assalamu alaikum. Welcome to video 16 of financial reporting. This is IAS 28 investments in associates and joint venture. This standard is applicable for your consolidation purpose. And this standard is going to definitely come because you will be tested on your consolidation. So IAS 28 will be tested in both your SBR and FR, which makes this standard a very important standard. So, under IAS 28, let us first understand what is joint venture. You have to understand two things: one joint venture and one associates. Because IAS 28 is going to deal with both of them, joint ventures and associates, but the way you measure them are same. Okay, joint venture is where you are having a joint arrangement where the parties are having joint control on the arrangement. Okay, so they have the right to the net asset of the arrangement. This will normally be established in a form of a separate entity to conduct the joint venture activities. What is associate? Associate is an entity over which investor has a significant influence, not control. That means if you are taking it in terms of the percentage, it is 20 to 50%. If you are having any interest between 20 to 50%, you are an associate. More than 50%, more than 20% and less than 50%. Significant influence is the power to participate in decision making, both in the financial and operating, but it is not a control nor is a joint control. Normally, significant influence means you are having a shareholding of 20 to 50%. So in the exam, either you will be given the percentage to decide whether you are having a significant influence to decide whether it's an associate, or you will be given whether they have the power to participate in the decision making of the investee. Now, equity accounting. So the one thing under IAS 28 is whether it's a joint venture, whether it's an associate. Once you have decided it's an associate or it's a joint venture, both you have to use equity accounting to measure them in your financial statements. Equity accounting. So in your consolidated financial statement, an investment in an associate or a joint venture is accounted using equity method. In your consolidated statement of profit and loss, they will only show a single figure regarding associate or joint venture. That is the investor's share of the associate or the investor's share of the joint venture's profit for the year. That is the only one figure which they will show. But yes, definitely for that you have to show workings. And on your consolidated statement of financial position, you will show the investment in the associate or investment in joint venture as non-current assets. So how do you calculate the equity accounting? Initially you will measure your associate or joint venture at cost, but the subsequent measurement will be you have to take the investor's share of the post acquisition profit. So your cost will increase or decrease by the investor's share of the post acquisition profit. If your profit increases, your cost you have to add it with the cost, and if it decreases, you will decrease it with the cost. So it can increase or decrease. That is equity accounting. So with the initial cost of investing in associate or joint venture, you add the post acquisition profit if it increases, or deduct if your post acquisition profit reduces. And you have to take the investor's share only. So investor share is you will be given in the exam. For example, they told that you have bought 30% shares. So that 30% is an associate. So you only have to take 30% of the post acquisition profit. Now, remember, associates and joint ventures, we do not consolidate them. Why? They are not part of a group. So therefore, any transactions and balances between the group companies and the associate and group companies and joint venture, they are not eliminated from your consolidated financial statements. Unlike subsidiary. What happens with subsidiary? When you're owning more than 50%, when you're having any transaction with subsidiary, that is eliminated on consolidation. All intergroup transfer and balances are eliminated on consolidated financial statements, but not for associates and joint ventures. Now, let us understand how do we use equity accounting through this example. So, P company is preparing group accounts on 1st Jan. They have purchased 30% shareholding in A for 30,000. So, what is the cost? Cost is 30,000. Retained earnings in the beginning was 25,000, but at the end it's 40,000. So, you have to say how much your retained earning increase, and you have to take 30% of that. So, A's profit for the year was 5,000. How did they get 5,000? So they have given the A's company's profit. Now, this is how in your consolidated statement of financial position it will look like. So investment in the associate will be shown under the non-current assets. That is 30,000 cost plus 30% of 40 minus 25, your post-acquisition reserve. Okay. Now, in your consolidated statement of profit and loss, remember, in your statement of financial position, you don't have to prorate. It doesn't matter what time of the year you are buying the associate. But when it comes to profit and loss, you only have to take for the period that you are an associate. If you're buying in the middle of the year, okay, if you're acquiring the associate, you only have to take for the portion that you are being an associate. So in this case, you see, you have bought it 1st Jan associate. Now at the end of the 30th June, that means after 6 months, they have given you what is the retained earnings. So at 30th June, from 1st Jan to 30th June is only 6 months. So you can only take the profit of 6 months, not for the whole year. Okay. So here profit is 5,000, but that is for the year you are given. You have to take 30% of it because that is the share investor's shares in that associate. And you have to take for 6 months. So 5,000 into 30% into 6 months, which is 750. So in your consolidated statement of profit and loss, you will show 750 as a share of profit of the associate. If that investment in A, that is your associate, if it is impaired for any reason, which could be impaired, okay, in your exam, your associate could be impaired or it could not be impaired, anything. If it's impaired, then that impairment charge will be deducted from the share of profit of the associate because it's an expense and you are having a profit. So that expense will be deducted from that profit and you will be shown the result. Thank you for watching, and this is all about IAS 28. But IAS 28, you can't do a question because you will not get one question where IAS 28 is tested as a standalone standard. It is often mixed and combined with other group accounting standards like IFRS 3, IFRS 10. For example, a parent might buy one subsidiary, one associate, or two subsidiary, or two associates. So you have to deal IAS 28 along with other standards that are group accounting. But when you are doing a group accounting questions, you will find out that there are other standards also that is applicable for the same question. But you can skip that and you can only do where you have to calculate joint venture or associate. That is using only IAS 28 wherever it's relevant. So that you can do from your revision kit questions. And in your FR, you will not be asked to account for joint ventures. It is only for SBR students, which is both associate and joint venture will be asked. But for FR students, it is only associate. So thank you for watching, and I shall see you in the next standard, which is again a very important standard. It is IAS 32, which is your financial instrument classification.